What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is July 28th of 2021. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to cut straight to the chase. As Bitcoin started to soar back up towards the $40,000 range yet again for the first time in over a month, and we've started to see larger levels of volume, I want to go ahead and answer the important question. As much as things have played out to our idea that this could very well be a mid-cycle correction, we want to get further confirmation, not just through price, but through the data science models. And that's what we're going to be mainly focusing on here today in order to get a non-biased and more broad viewpoint of making sure that this is merely a mid-cycle correction and that we could be setting up for a rally not only back to the all-time highs at 65K, but also possibly towards in 2022, six-digit territory, over $100,000 per Bitcoin. Let's go ahead and dive straight into it, guys. So doing a quick bit of price analysis before we do dive into the data science models. This is the first time, as we emphasized, in over a month, nearly a month and a half here, that we've revisited back up to this range here around 40K, and it's been continuous days of green since back here on July 21st. Now, price action alone is looking really good. The recovery here has been great, and yet again, we saw buyers coming in at historic support after the first wave of the bull cycle. Right, you can see here we broke past 20K, had the first wave here, we built consistent support where buyers were coming in on the dip, and then they drove the second wave all the way to 65K. And it is very common, again, I can't emphasize this enough, guys, both for Bitcoin and for a variety of other markets that have these kind of secondary waves in an overall market cycle. They come down here and they come down and make support before they make the next leg up and go on to do a third wave, a fourth or fifth, right? So we want to make sure that we see that support, and that's what we got every single time buyers came in. Albeit the price was slightly variable, it wasn't at one consistent price range. It never usually is. And you can see here that, again, they're at a general price range here around this big even level of $30,000. And buyers have been driving up the price. And it's not just showing in price, but it's showcasing the volume. Now, one thing that's important to note here, depending on what exchange you use, we're using Coinbase here, sometimes we use Bitstamp, we use a variety of different exchanges to pull up Bitcoin's price feed, as much as the pricing is accurate here. One thing that I think is always important to focus on is the volume profile. Now, Coinbase already showcases here that back here in July 26, 2 days ago, we had the biggest volume profile as far back as June 22nd, over a month's worth of price action, the biggest leap in volume on a single trading day. But it's important to look at BLX to make sure that the price feed you're looking at isn't biased. Maybe on one exchange you're getting more volume than the other. It tends to be that you can safely bet looking at one exchange you'll get a good idea of the volume profile so long as it's a liquid, real exchange on the spot markets. We can see here, though, that it does match up here on BLX, which aggregates all the volume. There was nearly 82,000 Bitcoin traded, or 81.8 thousand Bitcoin, the largest one we saw since back here on June 22nd. So the data lines up here, the volume's coming in, and you can start to see that even though we had a tall wick here on the candle for the 26th, where some of the gains faded as it was a short squeeze, you can see that buyers are coming back in. They're driving this thing back up here, and they're pressing towards that key resistance level at 40K. Now, I would love to see price break above not only this general point of resistance. I kind of want to play a little bit safe here. I want to bet that we're going to get above 42K on Bitcoin and not only close above there, but make it as support. Now, let's go ahead and actually take a look at the data science models here to see what the market's telling us. So, when we take a look at the R-HODL ratio, what's really fascinating about this indicator is that it shows us very, very clearly, and I'll go ahead and kind of detail what the R-HODL ratio is. You guys are always welcome to dive into the website I'm using. It's lookintobitcoin.com. This is one of the charts, the R-HODL ratio. It's one of the many data science models, and they have the indicator description here. But generally speaking, what the R-HODL ratio is doing is it's measuring the general price range that certain type of basically HODL waves. And you guys probably remember this data science model we've looked at before that analyzes the amount of UXTOs or unspent transaction outputs on the Bitcoin network that have not been spent in a certain time frame, right? So sometimes, for example, we see, generally speaking, over time that those who have been holding over 5 years or more, that metric slowly grows larger and larger, and you have fluctuations of people who have been holding over 3 months or less, et cetera. You can kind of get those different time bands in. But this is taking into account another factor here, which is realized profit, right? And the difference between two very different time frames, the realized HODL wave of those who are holding, again, in this case, for 1 week or more, and in this case, 1 year to 2 years. right? And you can see, as we can time it by the total market age, that we have a nice red line here, a ratio that varies over time. Now, what's so powerful about this is that it not only signals to us when there are significant discount periods for Bitcoin set to move higher, right? It doesn't always pick the absolute bottom. Fair point to that. But overall, you can see that when you get down into this green range, this is usually an indication of a capitulation period of time where prices have been down over 65, 70, 80%, the real market bottoms. We haven't gotten that this time around, right? We can see very clearly here in 2017, if that's the cycle people want to go off of, that it dragged down all the way from a ratio point of 103,525 down here towards 206, a massive divergence between the realized profit range for these different types of time frames. You can see back here, went all the way up to 200,000, collapsed down to 100, and the previous cycle there, 166,000, down towards 192. We didn't see that significant of a decline. In fact, we saw about a reduction to 1/3 of the original ratio value, from 15K down here towards around 4,500. Now, when you look at this chart, guys, do you see any similar cycle to this rally here, where we not only built support here in where we were in February 2019 at a ratio point around 200, but also peaked out at a similar range and had a similar low point where we started to find recovery and potentially have a setup for higher price moves? I want to give you guys a moment. If you guys see anything on the chart, let me know, because the one area in this chart that stands out to me is back here in the spring of 2013, March and April. We had a similar low point on the ratio before the cycle kicked off, right? And outside of that as well, we had a similar midpoint here, around 16K, not far off, down towards around 5,000. And all within a relatively short time frame, where inevitably, from this peak here in April, in November, just a couple months later, we were setting up higher levels and actually entered into the red band, which we never did on this cycle yet. Could it be that we're setting up for the next third wave here, right? We had, in this case, when we looked at price, again, the first wave breaking past the all-time highs, secondary wave, support at the support range of the first wave. And that gives us the room to break past these previous all-time highs, climb even higher, and potentially come down and build support at a higher range. That's at least what the R-HODL ratio is pointing to right now. The trend has not broken here. Whether you want to compare it to 2017, 2013, we have not seen the violation of coming up. We have not, in this case, we would be violating the trend that we've seen here 3 times in a row for each major actual cycle peak. Because this peak here in 2013 was not a cycle top, right? This was a part of the broader cycle here on the R-HODL ratio and a variety of other data science models. Some people would agree to disagree. At the end of the day, guys, I got to be clear on this, that I'm quite confident that this would not be considered a bear market, because it would be the shortest bear market in history, and then price took on exuberant levels of price action if that was really a bear market. It was a mid-cycle correction, albeit a significant one, just like the one we've had here, right? Let's go ahead and take a look at the 2-year MA multiplier, right? I, again, want to make sure that we're following a variety of the different models we have here to tell us whether or not we're in a bear market or not. I don't want to be biased here, guys. If it's time to get out, it's time to get out and park our profits. But when I look at the 2-year MA multiplier, one of my favorite ones, it's a very clean one. This one is taking, in this case, it's taking a value of over the 2-year moving average, which is generally a great indicator to find discount opportunities, but also multiplying that price at the time, the value of that 2-year MA or moving average, and multiplying by 5 times. And what's really nice is it can show you these extended periods of time here, right? It not only called all bear market tops, right? Excuse me, all the tops here in the bull market, but it also calls those exuberant periods of time, right? That one that we were just talking about back here in 2013, this spike here in May and April. What's really interesting is that this time around, although I will actually agree we shouldn't have come up here so quickly, we didn't even step close to getting above this, right? You can zoom in here. The price never actually went above the red line, and we started to deviate here back in May. What this looks like to me, if I'm being honest, is similar to how back here in 2017, we had many times where we tested close to the red line, and eventually once we actually got into the exuberant range where the retail FOMO was coming in December, when the CME and the CBOE, the major options exchanges, were launching Bitcoin futures, right? Bitcoin options and derivatives. This was the time period where people started to get irrational, where price got overextended. And within a matter of crossing this line, we get to the point where we go, okay, we don't have to sell out right this second, but we better get ready to start taking some profits, right? Every single time here, we set cycle tops above this moving average. We haven't even gone above it yet. Now, why again did we come up here so quickly? Right? Well, it's just like back here. Take a look, for example, the lower band that can tend to be ignored because people are just so focused on trying to call those tops in the market. Look at how we broke away beyond this line, outside of the capitulation range, right? This was very long compared to the last cycle here. And if we're going off of the expanding cycle theory, again, that's something that's, again, you can agree or disagree on. But just notice here how the capitulation phase took a long period of time here from the beginning of January of 2015, almost a full year going into December 2015, where it finally stepped above that line and had to make that area solid support before really starting to separate healthily and having that nice exponential cycle for 2017. Well, if we look at the chart here, we not only had a shorter time frame, really just a matter of December to April, so 4 months, not even half of this, and we started to break away. Why is that? It's because the dynamics of derivatives and credit, margin trading, people borrowing crypto that they can't afford to borrow because they don't have the additional collateral to protect themselves when they get over exuberant and overexcited and prices start to drag down, right? So they're starting to borrow crypto capital in this case to go speculate more and buy more. And what happens is that what we saw back here was a stagnation period from June of 2019 all the way here to October of 2020, right? Until we could finally get back up to that range. It was a year and a half pretty much of silence in the crypto market, as well as a dramatic sell-off here from 13,000 to nearly down towards 4,000 on Bitcoin. And that's because of people getting liquidated and people taking too much risk. It takes time for them to stock up and get more confident back into investing in crypto. Unfortunately, many of them make the same mistake and they continue to borrow credit they don't have, right? That they can't afford, especially if things are to turn down and go south. And that's exactly what happened here, guys. That's why we had a dramatic sell-off and why it's going to take a little while. I don't think it's going to take as long here. As you kind of tend to see when you go through these market cycles, the waves get shorter and shorter and they get more exuberant, excited. I don't think it's going to take as long as this. But at the same time, it's also why things might not recover vertically overnight. Right? So these are some interesting insights we can pull from the Bitcoin Investor tool, the 2-year MA multiplier. Let's take a look at the stock to flow. Stock to flow got a nice little bump up here with price, but look at where we set in the lows here, guys. It's really not complicated. -1 is the absolute solid discount range. If you get it, you're so lucky, right? There's really only been about 4 periods of time here, back here at the bottom of the first cycle, right? After the first cycle, the first bottom of the bear market. You've got over here as well in June of 2012, right close to that range, right before we actually kicked off the next cycle. We can see it here in July 2017 when we had the first major significant correction outside of breaking past the previous all-time highs of 2013 and the year of 2017. All right, you can see here, we started to deviate here against the stock to flow model. And outside of that as well, we had it over here in July of 2021, 4 years later. And now we're starting to leap higher. Historically speaking, this is a time to get optimistic, guys, right? And just make sure you guys can see that. I hope my camera doesn't get in the way. You can see here again, this also measures the days until the next halving event. Very similar color range here, getting into that yellow-greenish range. Take a look over here as well. Previous cycle. Yellow-green range here, right before we kicked off. Had the secondary wave. Again, let's take a look through some other ones here, guys. the MVRV Z-score. Now this is one that obviously might have looked scary to a lot of people because it does have more significant parabolic rises in short periods of time and also declines. This takes in market cap minus realized cap divided by the standard deviation of market cap, right? So you can see here again, as we're starting to move up here, there is much more, in this case, the overall price action here is starting to deviate further, right? The market cap of Bitcoin is deviating from the realized cap. So you can see this orange line here, it's a mixture, in a sense. The red line is more of the deviation on the ratio, right? But you can see here that as we get closer and closer to the realized cap and we actually go below it, that's when we get these buy periods, right? These are when you want to get absolutely exuberant, buy your bottom positions in the market. Well, what's interesting here is that even though we didn't come back all the way down here, right? Further confirming the idea that this is probably not a bear market, right? We also didn't come up here towards the extended band where we had over 7.5 or above. We did that back here in 2017. We did that here in November 2013. We even did that during what, again, we're claiming is a exuberant mid-cycle rally here with an extended correction, right? So this is actually relatively conservative to what we've seen in the past. But I think that's expected over time. We're going to see less euphoric rallies as markets start to scale, right? When Bitcoin is now a $1 trillion asset or more versus a $10 billion asset or a $100 billion asset, it's difficult to double like it was before. And you see what I'm saying? Like, it's much easier to go from $100 billion to $200 billion market cap, requires a lot less liquidity and adoption and support versus going from 1 trillion to 2 trillion. It's an important thing to understand. Now, we can dive back into this and see correlations here, though. Albeit, we didn't come up here and test the high point of the ratio. Excuse me, the data science model here of a ratio of 9 or above on the Z-score. What we did do is we had a correction down here. Generally around the similar range, we came back down here towards around 1. We dipped a little bit lower this time, around 0.5, but kind of based out around here, around 1. And then we had a secondary wave. And outside of that as well, you can see in 2017, we had a zigzag here. We had some pretty significant rallies and declines here where the ratio get cut in half, right? I keep saying ratio, I apologize, guys, but the data science model here you can see, right? The actual score here had many times where it had significant declines. Once more, you can see here as well the significant resemblance here of the capitulation phase, bottom here, rallying up here towards the value of August 2012, right? 2.18, came down here in the bottom range, similar range here, dipped slightly below it. The green band came out back up here, topped at around the 2.5 range. It's not always going to be exactly aligned. But again, we can't just analyze 2017. We have to see if there are other historical cycles that can give us some semblance of where we are, if we're in a bear market or if we've got more room to move up. Let's go ahead and take a look at the logarithmic growth curves. Now, as you guys can see here, over time, the logarithmic growth curves have been pretty consistent. The only anomaly here that we've really seen with the logarithmic growth curves that keep in line with the different Fibonacci deviations, right, was back here in March, where we actually dipped below here because of COVID, which really dragged Bitcoin probably much lower than where it should have been, right? But again, this is due to the credits, the derivatives, the margin in the market that's starting to distort things, right? Take a look at where we're at here, 0.245 on the oscillator. Right? This is basically an oscillator going between the top band, the bottom band, and the midpoint. So you can see the midline here is representative of this yellow center line here over time. This is the top line, this is the bottom line. 0.245. Where have we seen something similar to this? Something around this range. Interestingly enough, it's not enough to say that we're at a bear market here, right? We saw back here in 2018, that's where the value was, right? Not to mention, not only is this generally where the bottom is right here, it's all the way down at this range, but also, unlike the last 3 cycles, we didn't revisit the upper band here, around 130, 150, 200K, depending on when we actually set in that top. We just barely stepped above the midline. Funny enough, a low here is very similar to the low we had back here in July of 2017, 4 years ago. the first mid-cycle correction that Bitcoin had after it broke past its previous all-time highs. Pretty interesting. Let's take a look back here. Oh, look at that. July of 2013. 0.3. Not exactly the same. Relatively close, though, in the sense of Fibonacci deviations and the oscillator. And not to mention as well, look at the similarities here in the sense of April 2013. We stepped above that midpoint line, right? We didn't do that until later on in 2017. Again, 2017 is isn't the only cycle we should be focusing on. Let's take a look at the long-term time frames. And this is the great thing about the data science models, guys, is that, to be completely fair, data science models are not always perfect. You can always view a variety of different data sources, right? But we're trying to look at as wide of a range as we possibly can. And all of these models that have been time-tested with what we have to work with Bitcoin. And I can promise you guys, not many people are looking at these. If you're looking at these kind of data science models, you're part of the 1 to 2% of people in crypto who are actually engaged in looking at these long-term timeframes. The thing I love about it is that when you look at these data science models, it forces you to look at history. It forces you to get out of the daily chart, out of the hourly chart, what's happening today or what's happening in the next week or month, and it gets you focusing on what's been happening over the past decade. Bitcoin has given us a lot to work with now. Albeit we're not going to get the same returns that we had before. I would have loved to been able to buy Bitcoin at $2 and sell it at $1,000, right? Or, just keep riding it from there, right? But at least we know a little bit about how Bitcoin works, about how its monetary policy, as well as the way the market trades and invests in Bitcoin, how it plays out over time. It's relatively predictive. Now, not only is there something that I want to show you guys just for a bit of comfort here, and that is the days it's been profitable to hold Bitcoin. 97.2% of history here. Only around 100 days, 111 days, have been unprofitable. And that's really at the peak euphoric rally, the Dogecoin days, the absolute hype in the market, overt leverage being used, the margin trading going on. Bitcoin has been generally not only a profitable asset, it has been by far the most profitable asset comparative to things like the S&P 500, the NASDAQ, gold, silver, any traditional investment class. Even a 1 to 5% exposure in your portfolio over the past couple of years in Bitcoin would have outpaced all the returns if you had invested in the S&P 500 or the NASDAQ. That's how powerful this asset is. That's how much multiples this asset can provide. But I want to go ahead and focus on one last thing. Because I remember there was one data science model that a lot of people had pointed to that was sheer confidence. We found one data science model here, one single model here that had signified market cycle tops. And you know what? It even did a very good job of it in previous cycles. I'll give it that. And that is the pi cycle top indicator. Let's go ahead and take a look here at history. It's actually very infamous here because I'll first explain how it works. It basically is taking the whatever the price is on the moving average, the 350-day moving average, and multiplying it by 2. And it's also factoring in the 111-day moving average, right? So it's taking here what BTC's price is over time, right? Now, what's really interesting here, again, it's not multiplying 350 days times 2, it's the price times 2, similar to how we did the 5-year MA multiplier, right? Or sorry, the 2-year MA multiplier times 5. Bear with me here. Let's go ahead and take a look here at 2017. Pick the top precisely. And it's generally when this yellow-orangish line here, the 111 DMA, or daily moving average, knocks on par with the 350 daily moving average price value times 2. Picked it perfectly in December 2017. I'll give it that. Really, really picked it. Now let's take a look here. We've also got here in December of 2013, just a couple days and about, a little less than $100 off the top. Hey, to be honest, no one's ever really going to time the top unless you're really the guy who timed the top. And it's likely that you didn't pick the bottom if you're the guy who timed the top. This is a really great data science model. It picked the top here quite well. Not bad at all. If you can have something that gives you that kind of consistency, I'd want to keep an eye on it. But I want to focus on something here. It also here showcased a topping signal for the mid-cycle correction in 2013, where Bitcoin went from $213 down to $70. I think people are very eager to jump to conclusions when things are fearful. And I want to kind of drill my point here with just one simple question. Now, some of you out there maybe have a higher risk tolerance and like trading. If you're part of that camp, if you like to day trade, if you like to swing trade on shorter time intervals, maybe you don't have any tax obligations or a lower tax obligation for short-term trading, that's completely fine. This is more of a personal question. It's not actually really a gotcha question. It's something you need to ask yourself at the end of the day, because I'm not here to give you the ultimate answer, and I don't know what kind of situation you're in. Are you the type of person who's holding on in a general Bitcoin cycle and would want to take profit here and try to risk picking the bottom range here, inevitably to re-enter and trade up higher? I really wouldn't be the person to do that. And I can tell you why. Because even though right now, in the cycle we're in right now, we might very well be repeating 2013, I gotta be completely blunt that I don't want to sell my positions if I'm expecting further highs, right? Again, we're keeping with that mindset that yes, okay, I could use the pi cycle indicator, I could sell off here, and I'm gonna buy at a discount, right? I don't know how low price is going to go, because we didn't get a full 80% correction here. And if you'd waited for that and you kept seeing price go up and up, and you're like, oh, but my limit order's not getting filled, my limit order's not getting filled, and price eventually not only gets higher than probably where you actually sold it, but also in many cases, some people get left in the dust watching price climb higher and higher. My point here is this: why bet against an asset here that has shown so much resiliency over the last decade? It has constantly been one of the best assets you could dollar cost average into, and gives us a very clear roadmap of price discounts where we can in bulk invest into the market, build additional positions, mitigate your short-term loss here, and ride the broader wave where you know that the asset very likely has a chance here. If Bitcoin is going to be stepping towards a $2.5 trillion valuation, stepping in towards 100K or more, the picture starts to become very clear, and it depends on how much effort you really want to put in to your crypto investing. Because at that point, when you're putting that much effort into it, it really becomes crypto trading. And I can tell you guys, as much as maybe people can make money crypto trading, they not only start growing gray hairs on their head, but outside of that as well, they also end up not making as much money if they would have just simply averaged into the market and kept things simple. So, stepping back to the question here, I know it can seem sometimes I deviate a bit. Is there enough confidence signals here for us to not only revisit back to the all-time highs, but to go to that six-figure price range? I think it's overwhelmingly clear here, guys. Whether you're looking at some of the more bearish indicators like the pi cycle top indicator, or you're looking at a variety of the data science models we just looked at, or if you're looking at price action, all of it is showcasing the signs here that although it's not going to happen overnight, sometime here, later in 2021, more likely in 2022, we're going to be able to see more exuberance in the crypto market. If you guys like this rambling here on the channel, consider subscribing, dropping a like. It always means a lot. It's the best thing you guys can do here for the channel if you enjoy the content here. And again, for those of you who made it this far in the video, I appreciate you listening to me ramble. I hope it provided a good sense of substance value and maybe some good perspective that you guys are looking for in the space. And if you guys, again, like this kind of perspective, if you want to get more kind of diligent analysis here that isn't focusing on the day-to-day timeframes, it is really looking to position yourself for that longer-term trend in a variety of other asset classes, not just crypto, you guys can always check out the Dash report down below in the description. It's a great way to support the channel and a great way to get insights into the macro perspective that I have for both crypto markets as well as equities, commodities, and Forex. With that being said, everyone, I'll go ahead and close it off with that. I hope you all are having a fantastic day wherever you are, and I'll see you all in the next video. Take care, everyone.